Welcome to the Big Mike Fun Podcast, where you'll learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in. Because Big Mike has got the mic, starting now.
Welcome to the Big Mike Fun Podcast. I'm the Big Mike Zlatnik, and today it is my pleasure and a privilege to welcome back my really good friend, Glenn Stromberg. Hi, Glenn.
Hey, Mike, how are you?
I'm great. How are you?
Doing great also. Thanks for having me.
How does the great state of Texas treat you?
It's all good. It's all good. Texas is a great state, and we're getting some rain today, so it's we need it, and things are good. Things are good. So
that's great to hear. So, any particularly good news on family front? Just always just two quick sentences about the family. Everybody good?
Everybody in my family is doing really good. Yep, very blessed. And if everybody's doing good, and how about yours?
They're all doing great. Thank
Good.
God. So
Good.
that's great. Anyway, let's jump into the business of real estate in Dallas-Fort Worth area, and also we can talk a little bit about where you're investing in other states like the Carolinas,
Right.
and the manufactured homes, to be exact, not the mobile home, but the manufactured homes.
Right.
How is that business doing? We are, in the fall of 2022. The Fed is pushing rates. People are concerned about the economic conditions getting worse, and how things are going in the markets you operate in.
Well, good. I mean, what I look at is this, and I always say this, no matter how bad things get, people are going to eat first, have a roof over their head second, right? That's pretty much everything else is negotiable, right? And as well as I do, affordable housing, I don't think there's ever been an affordability housing shortage like there is today, right? America's down, 5-6 million houses, depending on how you look at it. So our demand is off the charts for, like I say, our leasing calls are ringing off the hook. And, what you said about the interest rates, the capital markets, things like that. I'll just pause for a second here, because back in 2000, before the 2008 crash happened, I was fixing and flipping manufactured homes. Most of our homes are 1,500, 2,000 square feet on a half an acre to an acre tract of land. And when the markets, when the deal crashed, the capital markets froze. So it really forced me into my current model, which is buying them, fixing them up, putting a tenant in there, property managing it. We turnkey some, and we also created a fund now for investors too that we can talk about later. But basically, I like to look at it as it's a recession-resistant model, right? No matter how bad things get, like I say, if people can't buy, more people rent, and we're seeing it. There's always a lot of people looking to rent, right? But we're seeing a real uptick in that right now, and in the Dallas-Fort Worth area, the average three bedroom house now is $2,500 a month. So it's
$2,500 a month rent.
That is correct. That's the average.
If you were to buy it, what would you pay for it?
Obviously it depends, that includes apartment complexes, everything else, right? Single family homes are, probably the starter home now is probably, $350, somewhere in there, $350, $400. And, that's kind of where the starter home is.
How about mobile home?
Yeah, oh no, ours are like, we're going to be somewhere between 90 and 120 is what we're going to buy them for. Right. And that's going to, they're worth more.
You're still buying 90 to 120 for a product that you're renting at $2,500 a month?
No, we're not renting for $2,500 a month. Ours rent for like around $1,700 a month in the Dallas-Fort Worth area here, 17 to 18, somewhere in that. It rents for that. But
it's still a pretty good ratio. If you rent 1,700 to 1,800 a month and the cost basis is 120,000, that's like 1.5%.
It's a phenomenal ratio, yeah, and that's the beauty of what we do, because it's usually less than half the price of a single family home, and rents are proportionally, much higher. So that's why we like our space.
That's remarkable. By the way, something really important, and I'm just curious, are the rents up recently on these manufactured homes?
Oh, absolutely.
What kind of rent inflation are you seeing kind of year over year now?
It's hard to even track. I mean, but it's somewhere in the vicinity of 30%. We've raised some from 1,200 to, like I say, 1,700. It depends on the area, but we're seeing tremendous appreciation, tremendous. And one thing for your listeners, just so they don't get confused on this, when people hear about manufactured homes, they think of parks, right? And these are not parks. These are on half-acre to 1-acre parcels of land. They have a deed of trust or a mortgage on them, just like a single-family home.
This is not a trailer in a trailer park, right?
Not at
This
all.
is a real home. This has just been manufactured at a factory and delivered, and then installed on land and basically kind of hardwired to the land. It's manufactured
Correct.
home, but it's not a mobile home. You
That is
can't,
correct. That is correct.
try the thing out.
Yeah, absolutely, absolutely. And they really are built to the same specifications as single family homes. If people haven't looked at them in a while, same flooring, same size, they can be tape and texture, granite countertops. They're beautiful. They're beautiful.
So they look like a duck. They quack like a duck.
Yeah.
They are a duck. They are a home, right? They just co-manufactured versus they build it right there on site, right? That's the only difference.
Absolutely, absolutely. So.
Yeah, I appreciate that clarification. So I'm really impressed to hear that the rents over year could be as high as 30%. I was expecting to hear like 10%, but from what I'm hearing is it's rent inflation is far outpacing the inflation, just the general reported inflation, right? And is the trend going to continue? But I want to make one quick comment. So I'm not surprised that the rent demand is increasing. This is a general substitution effect. When the rates go up, people can afford to buy. I mean, think about this, right?
Right.
People who buy, they generally get financing.
Yeah.
In order to get financing, you need to qualify based on your income. And as interest rates go up, the payment factor goes up substantially, and people just can't qualify under debt to income ratio. Yes. So what choice do they have? They still want to live in a good area. They wind up renting instead of buying it.
Right. And the other factor, Mike, is like in the Dallas-Fort Worth area here. The last time I looked, they say there's 3,000 people a week moving to the Dallas-Fort Worth area. So I mean, we're growing rapidly. You can feel the traffic. You can feel the traffic. It seems like every couple of months, it feels like it's more and more like we'll see the Saturday traffic jams now too. So people are moving here and they need a place to stay. And so, and like I say, the other factor is, depending who you listen to, they say that 62% of Americans are living check to check, right? That's somewhere in that neighborhood. And you think about that with inflation, with, who knows what the real inflation rate is. I believe it's a lot more than the CPI index for sure. But it's between, it's like I say, people are, it's squeezing people, right? So it's even magnified the demand for even more for affordable housing. So.
Yeah, that's the truth. The biggest problem for an average American is inflation, for the reason that paycheck to paycheck people or folks who are on fixed income, they can't tolerate this type of inflation because they are paid. If they're Social Security recipients on just pensioners, the pension doesn't go up.
Right.
And then the folks that work, the salaries don't go up nearly as much as the inflation, and that's been the biggest problem for American. What's really unfair is that all these government stimuluses that took place, most of those dollars found themselves in the hands of ultra wealthy. So during the COVID epidemic, the ultra wealthy got substantially wealthier. And then unfortunately, the average Joe hasn't fared as well. And that's the reality. By the way, that's the reason the Fed is fighting to get inflation under control. Because if they don't, the problem is just so massive for a lot of people. And the only tool they have is the interest rates. So let's go back to investing in manufactured home business. So how do folks invest in a business with you? Just again, explain the classic model. I know you got a fund going. So just talk a little bit about the fund. Just curious, what it's new. Last time we talked, you didn't have a fund. Now you do.
Yeah. So as you know, we do turnkey too, right? We sell turnkey to our investors. We property manage it for them. They're totally passive, and we do, we buy it, we rehab it for them. We property manage it. We have our company has a property management company inside of it, and so we do all that for them, right? our fund was, and the reason we came up with the fund really was, talking to our investors, they really wanted it, right? So what we tried to do was we tried to come up with a fund that, a lot of people right now are a little bit nervous with all the market conditions, right? So we call it the affordability housing fund, right? It's mobile vested is the name of the fund. And if any of your listeners want to, check it out and get the slide deck and all that good stuff, the PPM, it's at info@mobilevested.com. But we set it up. We tried to do it both for short-term investors and long-term investors, right? We set it up with a year, with a year hold. It's an 8 pref where our projected return is 10% for the year. So that is one option for the short-term people who are looking for a safe place to put their money and just, park the money for a year while everything in the economy shakes out, right? The eventual goal of the fund is, and obviously we can't guarantee this, and so we don't put this in our pro forma or anything, but the goal is to season it for 2 years, sell it to a hedge fund for a big multiple. It could be a big payday there. So obviously it's a place where people can set it, forget it. We just opened it the end of last month. We've already raised a couple $1 million, and we're really only looking to raise 5 to 10 million on this first one. So, but a couple of the other benefits are the investor will get the depreciation. They can compound the money. They can obviously take the cash flow or compound it, and it's both for accredited and non-accredited investors too. We can take non-accredited investors, and we also put it's got a 30% equity split, so it is an equity fund, and for the 1 year, for the 1 year hold, and then if people 50,000 is the minimum. If they put in $500,000, we give them a 50% equity split, and if they put in $1 million, we give them a 70% equity split. So that's kind of the quick overview of it. But like I say, to get the information, it's on the info@mobilevested.com if anybody wants the information, all the information on it. So.
Yeah, Glenn, thank you explaining it. So just to recap, if I understood you correctly, somebody writes a $100K check and they only want to stay for a year, they get 8 pref and 30% of the upside. And then if they stay for longer, well, if they write a bigger check, $500,000, they get 8 pref and 50% of the upside. And if they write $1 million check, they get 75% above. Did you say 75 or 70?
70
above 8% pref.
Correct.
Okay. Yeah, that's a reasonable terms.
Yeah.
And then it invests pretty much in these type of just buying properties and renting them out. That's the
absolutely. We're putting all performing assets in there. They're already performing, and so yes, they're.
Is this an open-ended fund or closed-ended?
It's an open-ended fund. Yes, open-ended fund.
Are you going to do what is known as a quarterly mark-to-market? You're going to value the portfolio on a quarterly basis?
Yeah, I mean, we've got our administrator Juniper Square, and I think that's part of what we what they do. Yes.
Well, the reason it's important, we obviously are on open-ended and closed-ended funds, and with open-ended funds, as new people come in later, how do you make it fair to the old and the new people? And the only way to make it fair is to value it periodically,
correct,
from time to time. So,
and
okay.
That's absolutely.
That makes sense. And as an open-ended fund in general, you don't have an expiration date, but that's a pretty interesting strategy to build a portfolio and then try to sell it to a hedge fund and then give everyone exit at that time, which is most people will be happy to get a good upkick if you can find a great buyer at a great price. So
yeah,
you probably have to build big enough portfolio, big enough critical mass. The hedge funds are probably not going to go for a small fund. You need to build, correct, I don't know, big enough.
Oh no, we plan on doing this. Like I say, this will be a big part of our strategy going forward. Yes, it's been very popular among our investors, and so yeah, it's like I say, we still have we want to offer both, right? We do want to offer the turnkey so people could be in the asset as an inflation hedge, and then this is they're an equity investor in this too, so they've got inflation hedge on this one too. So that's. But yeah, we wanted to give a shorter term option to our investors. So
yeah, makes sense. So you're going to give them 1 year lock-in period, and then beyond that they can redeem. for an open-ended fund.
They can redeem. Yeah, they could redeem if they want to. They can, like I say, set it, forget it. It's both qualified money, non-qualified money. So yeah, either one. So.
Well, it's actually great to hear that you put it together. We talked about this in the past, and
yes,
being a fund manager, I certainly can appreciate the fact that you launched a fund in your niche area of expertise.
Yeah,
this is your strength, and running a fund a little bit different experience than doing one-off deals. It's a beauty and a curse.
Yeah.
So you'll learn a little bit about that. There's more work involved managing a fund than individual assets, but at the same time, it also gives you a little more flexibility as a fund manager to make your investment decisions. You don't have to sell individual property to the individual investor. So,
right.
But plenty of people would prefer to give the money to you and let you make the decisions what to buy with it. So from that perspective, it's a great choice.
Yeah.
But let's continue the conversation. So where do you see things going into 2023? And it's a crystal ball question, and nobody knows. And I just, again, love to crack this joke. Crystal ball broke, looking for another one for sale, can't find another one.
Right.
But all that aside, you have a pretty good feel. Demographic, I guess, well, you can call it demographic change, or people moving into Dallas area is going to continue. Right. That trend is probably not going to go away. So you can expect some level of population growth. But the economy will start slowing down. It's almost inevitable. Dallas has enjoyed a great run for a long time. It becomes difficult to believe that 30% year over year growth is sustainable.
Right.
What do you think on a forward basis things going to look like? At least,
boy, Mike, I tell you, and like I said, of course, I don't have a crystal ball, and my personal opinion is America's an uncharted territory. I don't think I don't ever remember it in my career with the inflation like it is. The projections for oil prices, that to me, that's a black swan. That could be a black swan if oil goes to $150, $200 a barrel, which some people are calling for. The Russia-Ukraine deal. There's, I was at the American Association of Private Lenders last week in Las Vegas, and they had three economists on there, and I can tell you they're not painting a good picture for 2023. They think there's going to be a downtick in lots of stuff, right? I mean, and so I don't know. I mean, it's my, I always want to hope. I hope for the best, right? I hope for the best, plan for the worst, but it's, I guess I'm a little bit worried. I don't see nothing in Washington that they're doing to combat this. That's the part that kind of I don't see, raising interest rates. Yes, that technically makes a difference on inflation to some degree, but I don't know if that's going to be the answer. I don't think that's the answer. And if they raise interest rates too much, it could slow down the economy. It could mess up the economy. So I always defer to the experts and listen to them. But I think 2023 could be a tough year from what the people I'm listening to are saying.
Yeah, I appreciate that thought. And in general, that's the consensus. The U.S. energy policy, unfortunately, not going to change. And U.S. has plenty of energy, and it's going to be a tug of war between restricted supply and softening demand. So the rate increases are it's a demand destruction. There's no better way to put it. Just the question is what happens just on the energy front, how much demand they destroy, how fast, versus what the limited supply of new oil is going to.
Yeah, and the other thing, like I say, and I think it's a pre-election deal, right? But they've been going through the strategic reserves, right? Which that's not a good thing either. So
yeah, I heard that story, and then there's the argument that the change in supply, right? I mean, right now they're increasing the supply through the release of the strategic reserve, but in general, 1% in the supply change supposed to manifest itself to the degree of 5% in oil, right? So right. I don't know what the strategic energy reserve release, what percentage of the total oil consumption, but it is very possible the oil will go back up over $100 a barrel. And 125, 150, or 200 a barrel, that would be catastrophic for most of the people in this country.
You think of, I mean, obviously, the gas prices, everything's affected by it, and it would be catastrophic. I mean, and you look what's going on in Europe right now. I mean, they may have a really cold winter out there, right? Because they were so dependent on Russia for the natural gas and everything. So I don't know. I mean, I don't know, but hopefully we'll start drilling for oil and it'll get better. But I just don't see anyone pushing for that right now. That's the problem.
By the way, even if there was a change of policy, it takes a while to bring new production.
It absolutely
so unfortunately, that would not immediately solve the problem. And I'm not taking political position here. I'm all pro U.S. energy policy. I wish we were a little bit more smart about producing energy locally, and unfortunately, it's not changing anytime soon. Even if the composition of the Congress changes, the White House is still going to be Joe Biden is going to be running the show, and I don't think he's running the show. That's the.
I was going to let you say it, but I don't think he is either. So, but that's my take. So yes, I agree.
That aside, let's go back to the kind of your neck of the woods, and we can go. I love economic discussion, but we'll leave it for the economists.
Yeah, right.
So, what steps can you take as a fund manager or as an investor to prepare for the worst? Obviously, we don't know how severe recession is going to be. I've heard a number of recent corporate layoffs, and that's, by the way, that's by design. That this high interest rates will cause layoffs. Yeah. This is exactly what they want. They want companies to start cutting employees, and that's supposed to start slowing inflation. Right. So they're getting sort of exactly what they want. Now, maybe they want soft landing. They're probably going to get a lot harder landing. Nobody wants to say it, but it's probably what's going to happen. Right. But what steps can you take in your business to prepare for economic slowdown, and how would it manifest itself in your industry?
Well, and once again, my whole model was based on my 2008 experience, and because in 2000, like I say, in 2008 when the capital markets froze, I had 18 properties. I couldn't give one away. The FHA financing all dried up, everything at the time. So therefore I did the rental model, right? The rental model. And so what I learned was that, and I've got to believe this, right? That, no matter how bad things get, like I say, people are going to need a roof over their head. So I feel very good about that, right? The shortage of the affordable housing, everything else. So to me, that's the key thing. That's the key thing to where, you've got a good, solid, affordable asset underlying, whether it's a fund or if you own it or whatever. So that's to me, that's the main step that I can do, the main thing that I can do to, try to provide a good, safe, relative, nothing's risk-free. We all know that nothing's risk-free because, like COVID, none of us, how could any of us have projected COVID, right? You couldn't do it, right? You don't know if there's another COVID coming, you don't know, but, putting the odds in your favor, I get asked the question sometimes, what keeps me up at night, right? And I get asked that question, and, the only thing that does is the government, right? If they come in and start doing what they did with COVID and start things like that, then like I say, if they start doing that, I think we're all in trouble. We're all in trouble then. So it's you just got to try to put the odds in your favor the best that you can.
Yeah, I appreciate that, and I certainly see your picture. If you're renting for $1,700 for a house and you're buying it for $120,000, I mean, you don't really even care what happens with the value of the house. The house value can drop as long as you cash flow. You could survive pretty much anything.
Yeah, and that's the whole key, right? It's the old thing that our mutual friend David Phelps always says: the house doesn't know what it's worth, but it's all about the cash flow, right? The house doesn't care. You just don't sell during the downtimes. That's all. You just don't sell during the downtimes.
By the way, in this environment, with these high interest rates, this ratio is still incredibly healthy. And relatively speaking, there are very few asset classes where you can get that kind of cash on cash, even with a higher debt service. because of that ratio, 1.5%. So I have to say that that's definitely impressive. Anyway, we are almost out of time. Once again, would you be so kind as to share with folks how would they get a hold of you? One more time, the website for your fund.
Yeah.
And,
yeah, they can email me at Glenn, GLENN, at Stromberg, STROMBERG, investmentgroup.com. And then if they want information on the fund, just go to info@mobilevested, MOBILEVESTED.com. And they can get the information on the fund. And but either way, yep, I'd be happy to answer any questions and help anyone that I can. And once again, Mike, I really appreciate you having me on your podcast.
Thank you, Glenn. I'm honored to have you on the podcast, and always love to hear your feedback. It's a very different world. Texas versus New York. You guys live in a different country, so I'm really grateful to hear things in Dallas area. And
well, it's funny, and I think I grew up in the Chicago area, so yeah, I talk to my friends there. It's different up there too. So yeah, Texas is I like it. It's a good state. It's a good state. So
yeah, it's a great state. Thank you, Glenn. Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to BigMikeFund.com or visit Amazon and type Mike Zlotnick. Keep listening and keep investing Big Mike style. See you on the next episode.